Hi, everybody. This is the second part of our two-part series about analyzing investment properties in Canada. And if you haven't seen part one yet, you really need to go and do that because it's in part one that we cover the building blocks of real estate investment and discuss the profit centers that we're going to be exploring in the detailed analysis that we're doing in this video. So if you haven't yet had that experience of learning about the profit centers in real estate, go and take that video in, because that will really help you to make the most of what we're covering here today. The next thing I want to say is that if what we're going through today seems like it's over your head, I mean, there's lots of numbers in this, and this has been my profession for almost 2 decades now, and so it comes easy to me. But if it's over your head a little bit, what you should do is find a good realtor in the market that you're working in. There are agents like me in almost every major center in Canada that specialize in investment property, and I can help you find one. If you're having trouble doing that, just reach out to me with the contact information at the end of the video, and I'll be happy to do that for you. But a good realtor is really key for this, because they will help you to fill in the blanks of the economic modeling that we're going to do here, so that you've got reliable data going into your model, and that will mean that you can get reliable information coming out of it. And otherwise, garbage in means garbage out, and you might not be able to trust the numbers ahead of making a big decision about investing in a piece of property. But what we're going to do today is look at 2 different types of properties. The first one is a very common approach in the market that I'm very familiar with in Calgary, which is a conversion of a single-family home into a property with 2 suites in it, so an upper-level suite and a lower-level suite. So that's the property that we're looking at here, and in particular, this one already has a basement suite in it, and we're going to explore legalizing it. That's sort of the play in Calgary. So that's what we're going to be doing here, and I'll take you through all the numbers for that. And then we're also going to look at a condominium investment as well to get a sense for how the numbers shape up with that. So first things first, let's talk about this particular property that we're looking at here in Calgary. So this is a feature sheet that you would get from the realtor that you're working with, okay? And it's important to get the detailed feature sheet, because what you see on realtor.ca may not necessarily have all of the information that you need in order to properly analyze a potential real estate investment. And so this is sort of presuming that you're working with an agent and that they're forwarding you suitable listings based off of the criteria that you've provided to them. And so this one is in the area that I like. I'll just quickly show you, roughly where it is. This property actually sold a few months ago because I didn't think it was good to do one that's currently active right now. But at any rate, the numbers will be very similar for some of the other ones. So what I'm showing you here is just where in Calgary this is, and why I picked this as an option. So it's in the suburbs. That's how you invest in income properties in Calgary. That's where you get the best rent to price ratio. And it's also right beside a major piece of infrastructure, this West Calgary ring road that's coming through here. And if you zoom in, there's a big development that's happening in here. We've got a Costco and just this enormous development being put forth by the Tsuut'ina First Nation. And so if we want to optimize the passive appreciation in our investments, then we want to buy something that's in a location where other people, governments or private enterprise, are spending money to improve our location for us. Because as investors, we can improve the property and our management style, but we can never improve the location. We need others to do that for us. And so we're looking to maximize that here, which is why we've gone and picked this particular property in this particular location. So that's the deal that it is there. And here we've got some of the numbers on here. Now, what I'm going to do is I'm going to show you the tools that I use, and really any realtor that holds themselves out as a professional investment property salesperson, they can help you with the economic modeling, and they should have a tool like the one that I'm using here, this spreadsheet of mine that I put together many years ago, and have since evolved it and improved upon it to let me do my job representing real estate investors while they're shopping for property. And then, of course, I use this myself whenever I'm considering something I might want to buy for my own portfolio. But you don't have to use this sheet. This tells me what I need to know when I'm looking at a deal. But it might have a little bit more information than you really need to know if you're just trying to find out if a property makes enough income to support its costs or not. There's lots of sheets that are out there that are kind of like this, so you don't need to have this one. You don't even need one of these. And if you're working with a good realtor, they can provide one to you as well. But this sheet is a really good educational tool as well. It helps to teach people what parts of a deal you need to be considering and how certain real estate investments can stand out from one type of return versus properties that might be a little bit good at everything. So I'm going to take the data that comes from the realtor's feature sheet. We're going to go and grab other data, supporting data from a rental advertising company that will show us what rents are being asked for in the certain areas. And then we're also going to use some statistics from the Canadian Real Estate Association for some of our price forecasting. Okay, so in order to do analysis like this, you have to be able to pull data kind of from a few different places and be able to gather it all up into one modeler, which is for me the spreadsheet that I use. But you can use any spreadsheet. You can even use a sheet of loose leaf paper and just jot down the numbers if you need to. All of that stuff is certainly doable. And if you're not a pro in the business doing this for a living, selling real estate, you probably don't need the sophisticated tools that we have. But if you're an investor, you do want to be connected to a real estate agent that knows how to do all of this to help you out. Okay, so this is the property that we're looking at. I'm going to come on over here into my economic evaluator here, or deal calculator. And what I'm looking for is the purchase price of the property to use. Okay, so we're going to bounce back over here and we're going to see here up in the top right, hopefully you can see that it was listed for $445 and sold for $465. So we're in an active market here in Calgary despite higher interest rates. So we're going to come over here back into our modeler and we're going to put $465 into the purchase price plus GST. Now, renovations and upgrades, okay? So the strategy for this particular property, if we come back to it, hopefully I can pull up the pictures. I guess hopefully you can see some of this stuff here. But anyway, if you look here, this is a tenanted property right now, okay? That's split up into two suites, an upper suite and a lower suite. But it's illegal at present. And part of our investment strategy here in Calgary is to legalize this basement suite to take away that risk of having the city come and shut it down later. But you can see in here, this is a tenanted property. It's got all kinds of tenanted stuff in here. I love how the windows are sort of pasted over with flags and whatnot. And you can see down here lights and stuff coming in. And this is just so clearly a tenanted property to me. Your messy, busy bathrooms. So it's going to need a little bit of work, okay? And so we have to expect to put some money in. This is the basement kitchen, which is not going to be to code. You're going to need some venting there, and it's going to need to be cleaned up a little bit down here. So we need to assume a budget to put into our modeler. Now, how much money you're going to put into something, you may have a rough idea of that at the beginning of your investment, but you may not know exactly what it is, and you can improve that as you go. So if you don't know any better, my advice is to assume 10% of the current property purchase price as the amount of capital you're going to expect to put into it to fix it up and get it ready to go, okay? Now, there is a bit of a risk of oversimplifying that, but that's the number I'm going to use now. And then ideally, throughout your due diligence, you can amend that number if you need to get it to be a little bit closer to what it actually is. Maybe you get a contractor out during your conditional phase if you can do conditions, and your contractor can get you an estimate to do the work that you're giving them, and then that, of course, would go into your modeler. So we're back over here now. Renovations or upgrades. I'm going to change this to be $460 or $46,000. We'll say to legalize that suite. In Calgary, that's probably pretty close to legalize it and then fix it up a little bit. It's going to give us a good range here. So now we're going to get into the deal structure a little bit. Okay, so our total project cost is the purchase price plus our renovation amount, and then there's some soft costs here for legal fees and appraisal amounts and all of that. With respect to down payment ratio, we're going to put in the lowest amount of down payment that we can to avoid having to pay mortgage insurance fees or CMHC fees, okay? If you're buying something for your first house and you're only putting 5% down, my modeler will here go and show you exactly how much you will pay in an insurance premium, which is quite a bit of money, okay? $17,500 in this instance here at 5% down. But because we're investors and we're not going to be living in this property, 5% down is not an option. So we're going to be at 20% down, and then we're going to have this mortgage insurance premium set to 0 on this, okay? Now, depending on the lender that you're using and what your mortgage broker is telling you, and that's another resource that you need to have before you go shopping for investment property, is a really good mortgage broker that understands investment property financing. They may ask you to get a property that's got insurance on it anywhere, get a mortgage rather that's going to be insured, and there could still be an insurance premium on this, but sometimes that's how you get a better rate as well, okay? And so we're showing there as being no mortgage insurance premium for this particular deal, but depending what your mortgage broker gives you for advice, you may end up having a small insurance premium, okay? So our loan amount here is set at 80% of the total project, or sorry, 80% of the purchase price rather that we have in here. That's what that's computing. And our interest rate is 4% on this, and we're doing a 30-year amortization. So this is relevant for the profit center that we discussed in the first video, because where we talk about principal pay down. And you can see here, the shorter the amortization that you pick, the higher your mortgage payment is going to be, but then also the higher the mortgage pay down is going to be, okay? And so you may decide how you want to structure this depending on what's best for you, but if you want, after the best cash flow, generally speaking, you'll have a longer amortization period, okay? So you can play around with that, and that's something that you can find on any, like a mortgage calculator. Any major bank will have a mortgage calculator on there where you can put in the rate and you can put in the amount of down payment, and it'll spit that out for you. Scotiabank's got a good one, so does TD Bank. Those are all good ones to use. Now, make sure though, if you're using a bank's mortgage calculator, that it's a Canadian bank, okay? Because Canadian mortgages are different than the ones in the US. In Canada, the interest is computed semi-annually, not in advance. So there's just a little bit of a different adjustment there for interest rate payments versus US-based mortgages, okay? So you can use any major bank's loan calculator to help you out with that. I've got it embedded into my sheet, so it's in one place. And I can use it offline if I need to, and that's why we have it set up here. So I'm going to leave it at 30 years for amortization, and now we're going to get into our operating costs and our rental revenues, okay? So coming back over to the property that we were looking at here, this has got 2 suites in it, all right? There's an upper unit and then an illegal basement unit as well, all right? So we want to have a rough idea of what we can assume the rent rates will be after we've completed all of our renovations. And so to do that, I have a really good sense for what is going to rent for what, because I own a property management company in Calgary that looks after hundreds of units just like this. So I'm in the zone with this. I know what to assume for it. But if you're new to an area or you're not sure, go and find a rental advertising site where other landlords will post their vacancies available for rent. So I'm looking at one here that's very common for Alberta. Rent Faster is by far the most common site, and I've got a filter on here that will filter the results to only show me main floors, okay? And it's doing that for me now, and there's a couple candidate options here. So if I click on that, you can see, well, it should be coming up here. Hold on. There we go. Okay, so $2,000 for a main floor here, 2-bed plus 1 bath, and this one's been cleaned up a little bit. Here's one for $1,600. This one is quite a bit of money, $2,700. That must be fully finished, and another one down here for $2,500 for that. So it's giving you a bit of a range there that you can use. And so what I'll do is I'll come back over to the modeler that I'm using, and I'm going to be, going off of what I think this property would rent for based on my experience. But this is something that you would go to your realtor for, okay? Your realtor should be able to tell you what these units will rent out for when they're completed. And if they can't do that for you, your next option would be to whatever property manager you're going to use, if you're going to use a property manager. But if a realtor won't do the work to go and find out what your unit's going to rent for, you should pick a different real estate agent for your investment property purchases. Okay, so I'm going to say that including utilities, we're going to get $2,200 a month out of this 3-bedroom main floor that we have here in the lower suite. I took a look already before recording this. It's probably closer to $1,500 rather than the $2,200, but gives us a total gross income for our little house in suburbia here in Calgary of $3,700, which is awesome rents. Now these are going to include utilities, okay? And the reason I'm including utilities in my model here is because it's impossible in Calgary anyways to separate the utilities for one amount for the upper unit and then another for the lower unit. It's cost prohibitive to do that in a suited conversion. And so there's one utility account that will go to the landlord. The landlord will pay that, and then you split it according to, usually it's number of adults per lease is what I do across your 2 tenants, okay? So a little bit of an experience factor there. That's also market dependent. Maybe the property that you're looking at does have separately metered utilities, and you can go about that in whatever way suits you best. But for how we do it in Calgary and for our model here, we're going to include utilities in that for a gross rental amount of $3,700. Okay, now I'm also including property management in this at 10% of the gross rents per month. However, if this is your first rental property and it's in your market area, I really recommend that you self-manage for your first property or two so that you know what to look for and what challenges you're going to be giving to a property manager when you go and hire one. So many real estate investors just give their units to a property manager and they've got no clue or concept of how hard it is to manage property properly, and then they get frustrated if there's gaps in income or unanticipated costs and that sort of stuff, and they can place the blame on their property manager when really there's a bit of a lack of experience there on behalf of the investor. So really consider managing your first property yourself so you learn this part of the business, and it will serve you well as you progress through your career. Now, some of the other variables on here, property tax is an easy one. If you come back over to the feature sheet that we were looking at, give me a second here. Here we go. You'll see on here, there's a property tax amount on here of just under $3,000 per year from 2022. Your realtor and the feature sheets should be able to provide that to you. So I've gone and I've put that number in here, and that's what's cranking out here. That's a monthly number, so it's that annual amount divided by 12. Insurance amount, so this is based off what your insurance quote would be for the year and then divided by 12. My insurer typically insures these things for around $100 to $140 per month for each of the properties, and so I've got 115 built in for my assumption here. Vacancy rate, I've put in at 4%, which is half of 1 month's rent. So basically having one of the 2 suites vacant for 1 month per year is what I have in as my vacancy rate. If you're not sure what rate to use for that, you can contact the landlord association in the market area that you're considering, and they'll be able to tell you. You can also look at CMHC's rental market forecasts, and they'll break it down for you community by community and explain what the overall vacancy rate is there, okay? But I like 4% as a rate, and if you're in an area that's a bit more rural, then so you're not in a major municipal center, you may want to bump that up to 8% or 1 vacant month a year, okay? Utilities, this is an amount that's again averaged out over the whole year for this property. I'm using my experience based off of other properties that we've managed. If you're not sure what to use for utilities, this is something that you could ask the seller to provide to you as a due diligence item. So ask them for 12 months worth of utility statements on there so that you can crunch the numbers and do the math to find out what variable you should put in for that. Now, there's other things that are going to be at play with this, whether you're taking a fixed term contract or you're paying the market rate for utilities. There's all kinds of stuff like that, and in particular condos or strata properties may have some of the utilities that are shared by everyone in the condominium complex, but we're looking at a detached property here where that's not the case, and I'm going to use $450 per month as sort of my assumption and my assumed variable for that. Now, repairs and maintenance at 5%. So this is 5% of the gross rents per month as a repairs and maintenance budget, okay? So you're not going to have to pay out this 5% every month for repairs and maintenance, but if you take it in and work it into the operating costs that you're looking at for your property evaluation, then it will tell you, how much you should expect to pay over the whole year. So you may go 8 months with nothing, and then okay, you got to change out an appliance. That's going to be $1,000 and change, and then there you go. You've got a budget saved up for that in your year's cash flow forecasting. So I like 5% for this. The more money that you put into renovating and cleaning up the property in your renovation budget, the less this repairs and maintenance budget amount needs to be, okay? So if you're looking at a brand new property, maybe there's a warranty. If you've spent, tens of thousands of dollars fixing a property up, you've got the property inspected, you've fixed everything on there, you can be a little bit more assertive with your repairs and maintenance budget, because you know what's going on and how your property is going to be working for you. Now, if you're buying something that's got tenants in place and you're not putting any work in, this repairs and maintenance budget may be much higher than that. Okay, you may need to go up to 8% or more, depending on how hard a life the property that you're considering has lived. And then you'll get you put in other variables in here if you want to. This could be stuff like whether if you're including cable or Wi-Fi, or if you've got a fully furnished property in here and you want to have a furniture budget or something like that. If there's other expenses, you can factor them in for that. And that would also be a good question to ask your realtor. Hey, what am I not seeing here? And they should be able to give you their professional opinion as to what you should expect to include for operating costs. Taxation could be one. If you're in a location that, say, has a speculation tax or a vacancy tax or something like that, you may need to include municipal taxes onto your operating expenses. And then we'll get our net income. So our net operating income is our gross rental income less our operating expenses, okay? And then our cash flow here after debt service will take out the monthly mortgage payment from it as well, all right? Now I've got a little formula in here where I calculate the capitalization rate. That's a pretty sophisticated metric for income property analysis. It's much more common in commercial property, but I've always liked just including it because it's an easy thing to just stick in there. All the capitalization rate is the total annualized net operating income divided by the purchase price, and ideally you want this to be above 4.5 is what I would consider to be a good capitalization rate. So anyways, we're not going to talk about that today. But that's how we've got the numbers in here for our model. Now, the really good news is that this property seems to spit out very healthy positive cash flow. So this is good for real estate investment property that is under 500 grand that we're putting 20% down on. Okay, now we are putting some renovation capital into this, so we're going to have a little bit more than 20% equity into the deal. But this is a really good cash flow number in my view for a property like this. But you can see here how many of these it's going to take to change out someone's employment income, right? It's quite a bit. And you can see based on the total amount of cash flow that we're getting, first, before I go into that, let's talk about the projections for, asset value increases and all that. So we've got our operating income over here, cash flow after debt service. It does cash flow. This is good news. So once we know that we're at or pretty close to break even or better for income property evaluation, then we can go and start to look at the longer term economics of this and the other profit centers that we want to be taking advantage of. Okay, and so we need to decide what we want our market growth rate to be. And we've heard all about these crazy rates of appreciation. Some of them have been up in like the 20% range per year. Really hard for me to put that on a pro forma to put in front of a client. But mid-single digits is very realistic now for that. But if you want a bit of an idea for how to decide what to put in for a market growth rate, asking the realtor that you're working with to provide you some market data really relevant to your location that you're shopping in would be one way to do it. And if you also take the next step and go to the a real estate board in the market that you're looking at, they will often employ economists to go and provide some of these forecasts. Now, if you don't want to do any of that stuff, there is a good resource to try and estimate or at least see what's been happening with respect to growth rates. And that's by looking at the Canadian Real Estate Association. So we're here on the CREA site right now. If you navigate over to it, you can see the monthly statistics packages that they have. And that's what we're looking at here, these national statistics. These come out every month. But way down at the bottom of this page, there's this super cool little modeler over here, if you will, where you can input the data that you're looking for over the time frame that you want it evaluated for the type of property in the market, local market that you want to consider. And so we'll go ahead and we'll look at this. We're going to pick actual. We're going to pick property type. Let's look at single family, because that's what we're shopping for here. And then let's go for an area. Let's go down here to Calgary, because that's the market that I'm in. And I want to be able to see what's been happening, say for the last 3 years or so. And then it's going to go and spit out some of this data for me. Now, if I want to see in here, I can go to difference by time frame. And hold on, it's going to come up for me. It's supposed to anyway. Oops. Hold on. Single family. Oh, it's because I didn't hit apply, of course. There we go. Take the composite out. Single family only. Apply. Property subtype in Calgary. Apply. All right, here we go. Okay, so now what we're looking at is the percentage in changes in price for Calgary for a single family property going back 1 month. All right, so if I want to go back, say 6 months, and I can see, and it's showing me here, prices are 2.7% higher 6 months ago. So maybe that might be 5% or so over the whole year is in terms of actual operating data that's coming out of the market right now. Okay, so not like the cleanest way to do this. Generally speaking, I will pick a rate for my market area and just go with that. It's very seldom is it going to be less than zero for say the 5-year evaluation time frame, which is what I'm using for our analysis here today. So I'm going to go with 4%. Okay, that's what I'm going to pick. So what this means is that over the next 5 years, prices are going to go up by 4% a year in my model. All right. Now I'm also going to look at what the rental rates are going to go up as, because as you know, we're in an inflationary environment right now, and that's also meaning that rents are being inflated as well. Okay. So you can choose, in my model anyway, to grow your rental rates, but then you should also increase your operating costs. Okay, so come down here to your total operating expenses, and in my view, whatever your rent rates are going up by, you should increase your expenses by approximately the same amount as well. Okay, now sometimes you could say rents will go up more than expenses will, and generally that is the case. And the rental amount is the biggest number. It's your top line revenue number here at $3,700 for what we're looking at. And your expenses, or all of your operating expenses here. But if your property is cash flowing in your first month, then you'll never really have to worry about this. And then as your rents are growing and your expenses, if they're growing at the same rate, if you're cash flowing, your cash flow amount should increase a little bit each year. And you can see here in our model for this property, it does increase a little bit. Okay, so if we're using 4% per year for a model, and we're increasing our rent rates and we're increasing our expense rates as well, we can start to see how this single family deal shapes up according to our profit centers. So passive appreciation at 4% per year. We're starting our project value at $511,000. Now we bought it for $465,000, okay, but I include the hard cost and value that's gone into the property. So if I've got materials and labor, I think that the property is worth more if that amount of money has gone into it. And so that will be the price that we will then apply our rate to. That's how I look at it. Other people would say, no, it's whatever you bought it for, and they won't include that. In my view, the property is worth more and would appraise for more after this work is completed. And so that's the starting number that I like to use for my modeling, and that will show you then that your pricing is going up each month, okay, or each year rather, by that 4%. So after 5 years, we've got a value increase here of about $110,000. Over that same 5-year period, we've been paying off our loan, right? So every mortgage payment that we're making over here at $1,700 a month, well, we're reducing our loan balance at the same time, right? So we're starting off with a loan at $362,000. After the first year, it's down to $356,000, and then each year thereafter, it comes down a little bit more. Okay, and so you can see here after that year, we've paid off about $35,000 in mortgage paydown. Now, cash flow, this is a good property, okay, for cash flow. We're up at almost $500 a month here on this one. This is a pretty good one. But you can see here, it's still, the cash flow returns are still dwarfed by the asset value increases, right? So picking a property in a good area where it's going to increase in value is the most important factor for successful real estate investing in Canada right now. Now, you don't want it to eat you up every month, which is why you need some positive cash flow. But usually this cash flow is there to enable this return from the asset value increase that we're getting, okay? And then, of course, along the way, your tenants are making you money while you sleep by paying you enough rent so that you can make your mortgage payments and pay off that debt along the way. Now, in our model here is an option for active value add. So active value add would be that active appreciation component. And this would be, this renovation amount that we're putting in here. Is there a value over and above this cost that we're putting in, okay? I would make the claim that yes, there is a small value for that. We could put in, say, $15,000 into here, and that will increase that return just that little bit. But basically, that's the time and trouble amount that is there for an investor that's actively adding value to their property, right? So you're cutting a $46,000 check. The time and trouble that it took you to navigate all that and deal with your contractor should be worth something to a purchaser who might just come in and buy it. And so I like to say, it should be maybe 25% of your total renovation amount should be the amount that you're coming into with this. So based on my experience with these secondary suites, this isn't all that far from it. Maybe a little bit better than 25% here, but we're going to say $15,000 for that, which then gives us an overall 5-year return of about $192,000 for this. And then the annualized amount is just this 5-year amount stretched over 5 years. So what you would make each year to get this $192,000 gain. Now our 5-year or the percentage amount or 5-year return is also based off of the amount of money that we've had to put into the property. So our down payment plus our renovation amount, okay? And then the returns, these percentage returns that we're getting are based off of our capital commitment to the deal versus the amount of money that we're getting back out of it, okay? So this is a nice little deal that really makes up the kind of bread and butter of Calgary-based income property investors. You can see here how the 5 different profit centers or 4 different profit centers are split up. It's heavily weighted towards the asset value increase, but you want to be able to know that even if it didn't appreciate at all, are you still going to make money? So if we put 0% in here for market growth, and we have no appreciation at all, well, yes, we are still getting a modest return here because we're paying off a lot of our loan, we're paying off our we're getting good cash flow out of it, and we've added value to it by way of putting in this legal secondary suite into the basement. But over the course of 5 years, we're certainly going to see some appreciation in here. I think 4% is a good rate for that. You can see here just under 200 grand return, and this is where you want to be, is these kind of mid to high teens for annualized appreciation rate in a Canadian real estate investment. And if you've got that as well as cash flowing, you have got a good investment property. So I like this deal in Calgary. That's why I've sold hundreds of these things, and our agents here have sold so many of them, and we'll continue to do that here in Calgary. But you can use the same type of approach in any property that you're looking at across the country. You just need to know your variables, right? Your rental amounts that you have coming in are going to be important. You really need to get the right operating costs. You need to know the right financing structure that you have coming into this. And then get a bit of a sense for whether or not the amount of capital that you have to put into the deal to get that income return out of it, whether or not you're going to get a bump on that investment that you put in in terms of active appreciation. So that is the single family property analysis. Now let's take a quick look at a condominium. All right, so now we are doing an investment analysis on a condo apartment deal, also in Calgary, just because I have access to good data here. But the same premise could be followed in any market that you're looking at across the country. So I've got a feature sheet for a condo up here. I guess while I'm at it, I'll tell you why I picked this particular property and where it is. So let's click on this first so I can show you where this condo is in Calgary. Just give it a minute here to get fired up. Okay, so here's where it is. It's located in a community called Inglewood. And why did I pick this particular community for this unit? Well, because Calgary's getting a brand new hockey arena, all right? You can see the Saddle Dome here. That's going to get torn down. And we're going to see a complete redevelopment of the Rivers District, which is basically this section of the east end of downtown Calgary, and the Stampede grounds and all of that stuff are going to be completely modernized and turned around. And so I want to be close to all that action with my investments, and I want my tenants in the future to be able to walk to hockey games. I want people to come to Calgary on a short-term basis and stay in my unit and take in the Flames game, or come during the couple weeks of Stampede each year. I want those options with my apartment-style condo. And so this is how you maximize your passive appreciation, because you buy in an area where other people, like governments or private enterprise, and in this case both, are going to be spending money to improve your location for you. Okay, so that's why I picked this condo here in Inglewood. What can I tell you about the condo itself? Well, it's a 2-bedroom, 2-bath unit, about 800 square feet or so. It's comfortable, okay? It could be used as a fully furnished unit for short-term stays if I wanted to do that, all right? Because it's big enough and doesn't feel smushed in. It's a 2-bedroom, not a 1-bedroom, because anybody that needs a 1-bedroom will rent a 2-bedroom for the same price or a little bit more if they're available while they're shopping. So I find 2 bedrooms will decrease my vacancy risk at the same time as also renting for a little bit more money and having a more stable tenancy as well. Okay, so that is the unit. You can see here from some of the pictures, it's pretty nice looking inside. These look like developer pictures to me, or renderings from it. And they look pretty darn nice to me. So I think this will look good enough on Rent Faster to be able to rent out. So what we would do here is we've got our pro forma here together, our feature sheet together. Now we're going to jump over and put together our economic evaluator. Okay, so we're back into my sheet that I use again, but you don't need to use this if you don't want to. You can do this yourself if you want to as well, with the same techniques we talked about before. But I like this also as an educational tool to speak to the profit centers that we have in real estate. So I've already inputted a few of the numbers in here just to save us some time. I put in the purchase price of this condo. It's $380,000. For renovations amount, I put in a little bit less than what we had in the single family investment. And that's kind of what you want if you're investing in condos. You don't want to have the outlay of cash for your down payment and also a big renovation amount too. You shouldn't be doing that if you're buying apartment style condos. There's enough new ones out there that you want to preserve your capital and not have this project risk and an additional outlay to renovate it. So we're only putting $5,000 in for renos and upgrades. Our down payment is staying the same, and our debt structure is about the same on this, all right? We've got 4% as our rate, 30-year amortization is what we're putting into this. Once you've got the financing rates figured out and your amortizations figured out, it will stay about the same regardless of what property type and even location in the country that you're looking at. Now, for rents in here, it's a little bit different. We don't have 2 suites this time, and I'll show you one of the benefits of shopping for condos is that if we want to find out what it's renting for, as you can see here, this is Inglewood. You can see over here, and lo and behold, in Inglewood, you can see that somebody else in the exact same building, whoops, I zoomed in over here, has got a unit up for rent that looks just like the one that we've got. And it could even be the same exact unit right now if it was sold and now is on the rental market. But you can see here, 2-bed, 2-bath, 850 square feet. They're asking $26.30 for this. And so without knowing a better number to go with, that's the number that we're going to put into our analysis. And that's what I've done. So we've got $2,600 here of rent has come into that. We're leaving property management in. Property tax, I've adjusted for this. For whatever reason, this is more expensive than the suburban house that we looked at. Insurance is going to be significantly less than the single family property because the condo fee, which is expensive, we'll look at that here in a minute, includes the building envelope insurance. So we only, as individual owners of the condo, we only need to pay to insure what's from the paint and in, so like cabinets and flooring and that type of stuff. So significantly less than you would have on a single family home where you have building and all of the other stuff in there that you need to be worried about, okay? Vacancy, I'm keeping that the same, 4%. That doesn't change very much. Now, utilities are included in the condo fee that we have for this. So let's jump back over to this, and you can see here, whoops, this is the one that I wanted. You can, if you come down here to what is included in your condo fee, okay? Our condo fee is expensive for this one, $618. And it includes all the regular stuff that you would assume, but it also includes heat. This is what I'm looking for here, okay? It also includes water and sewer, snow removal. All that stuff is included in that condo fee. But so what that means then is that there's no utilities expense that I need to take on as a landlord, because the electricity can be signed up for by the tenant, and they can pay for whatever they're using. Okay, so we're going to keep utilities out of it. Repairs and maintenance at 5%. That's probably a little a little more than we really need, but let's just be conservative with that. And then, of course, we have our condo fee in here that we need to put in, which brings our operating expenses up to this. And you can see here, this investment property does not make enough money to cover off all of its costs, okay? And condo apartments seldom do. You can get around this by boosting up your rental income if you're doing stuff like fully furnished rentals or on a short-term basis or something. But looking at this, it does not cash flow. We have property management in here where if we zero that out and now we're self-managing, it does break even. And many landlords will choose to do that. Once they have a tenant, they can manage it themselves, because these condo apartments are pretty easy in that respect. So we can, maybe what we'll do for the sake of our overall analysis here is put that in. Or you know what, let's not. Let's just reverse that back out again and have our condo fee in there. So you can see here, we're losing money every month on this deal. And over the next 5 years, you can see that's the same case in here. So looking at our total project value and the long-term economics. Now for market growth rate, you would want to look at, we've got a different asset class now, right? We were in single family, now we're in condo apartments. So if I come back over to my CREA analysis that we did, the same sort of thing here, this monthly stats, and we come in here, I've gone and put the numbers in here already. So we're looking at apartments, we're looking at condos, and we're going back 6 months. So we've actually we're growing in price for condo apartments in Calgary. And that's legit. We're seeing more demand from people moving to Calgary right now. And we haven't had the new construction units that we've had. Many of the units have not hit the market. So pricing is appreciating for condo apartments in Calgary. Now, I can't believe I'm saying that after everything we've seen in the last, decade and change here. But right now, anyways, we're seeing positive growth inside the condo market. Now, I'm not going to use this 5.6% here over the last 6 months of mine. I'm going to stick with my 4% number, and I'm going to stick with the same assumptions I had for single family, which is a rental growth rate of 2% per year and expense growth rate of the same. And then that now works its way into the 5-year evaluation time frame that I use when I'm considering a real estate investment. You can see here our cash flow will slowly come up each year, but we're still losing money. And over the 5 years, we've lost a total of $10,600 is what all of this stuff adds up to be, okay? But if our property prices are going up by 4% in this condo that we paid $380 for, well, at the end of 5 years, if it's worth $470,000, it's worth it in the grand scheme of things for us, okay? And that's the trade-off that you have to make as a real estate investor is, are you okay to feed the negative cash flow beast down here, all right? In order to get a property where somebody else is paying off your principal for you, and also it's hopefully increasing in value. Now, we're not going to have an active value add over here. I should put that to 0. But you can still see here, this is a good deal as long as the pricing is appreciating. Now, if it was not appreciating at all, then it's not the greatest deal, right? All you're really getting for that now is the mortgage pay down which is about 3 times the amount of cash flow that you're getting out of it. So your negative cash flow isn't killing you because you're paying off more principal than your negative cash flow each month. But still, if you weren't appreciating at all, not the greatest investment, okay? But we're going to say that it is going to appreciate, and that can often be the deciding factors. Do you believe that this asset class is going to grow in value in the market that you're considering? All right, so that's what we have in here for this. You can see here the profit centers, 82 grand out of asset value increase, good healthy mortgage pay down. We have negative cash flow, so we're feeding into this each month, which means that our overall return here is still going to be good, still $100,000 as long as prices continue to appreciate over that time frame. Okay, so I hope that you found that valuable. I know that this was an intense video with a lot going on here, but you can really see all of the different factors that you need to consider if you want to be a successful real estate investor in Canada. So lots of stuff to go through. Your realtor is your best asset for this type of property purchase. Okay, you need someone that knows numbers, that really knows the area, that's not just going to sell you a property because it looks nice. Realtors like that, or that specialize in this, are really kind of nerds for investment property, and there's usually a few good ones in every market. So if you need a good one, let me know. I'd be happy to help you find one. And this has been Investment Property Analysis. If you've liked the video, it would be awesome for me if you could give it a like and subscribe to my channel, and we will see you on the next video. Thanks, guys.